Hello everyone, welcome back. My name is Niles, and in today's video, we're going to explore spreads and slippages when using the XRP Ledger's native decentralized exchange. And in this video, I'll be using the Sologenic Dex for our examples. So without further ado, let's dive right in. In financial terms, a spread simply refers to the difference between two values and commonly describes the difference between two prices, such as the bid and ask price of a stock or the buying and selling price of a currency. On the XRP Ledger Dex, the spread refers to the difference between the buy orders and the sell orders for a particular asset or currency pair. In this case, the XRP and GitHub USD pair. So here we can see the lowest sell order for XRP USD is 2.457, and the highest buy order is 2.344. In this case, the spread value, which represents the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept, is 0.113. In comparison, here we can also see the current spread on the XRP to Bitstamp USD pair is more favorable than the GitHub USD to XRP pair, likely due to better liquidity behind the Bitstamp pair. The spread on the XRP Ledger Dex can vary depending on various factors, including the current level of trading volume and the liquidity of the market. And a tighter spread on the XRP Ledger's Dex is generally considered more favorable, as it can provide traders with better opportunities to buy and sell an asset at a favorable price. The term slippage refers to the difference between the expected price of a trade and the actual price at which the trade is executed. Slippage affects a trade as a percentage of the order, so you can imagine that if a slippage, for example, is 3% and the order is $1 million, the loss incurred due to slippage would be $30,000, which is quite substantial. So that being said, it's important to be aware of how slippage can affect an order. On the Sologenic Dex, you can calculate the expected slippage based on the current available orders. For example, let's say you want to place a market order to buy 1.2 Bitcoin via the BTC Bitstamp USD trading pair on the XRPL Dex. The buy order will execute based on the current liquidity available through the open sell orders on the order book. In this case, you can see that the current open sell orders would result in a purchase of 1.2 BTC at an average price of $24,861 per Bitcoin for a sum total of $30,490. In this case, the existing spread of 1136 would result in a slippage of approximately 4.6% when executing this buy order. In general, slippage can have a negative impact on the profitability of trades, particularly for short-term traders who rely on small price movements to make a profit. Slippage can occur for various reasons, including market volatility, low liquidity, and as we mentioned before, typically occurs when placing large orders. It is therefore important to be aware of slippage when trading and to take steps to minimize its impact, such as placing limit orders to control the price at which trades are executed. And that will conclude this video on spreads and slippages when trading on the XRP Ledger Dex. Thanks so much for watching. Congratulations on using the XRP Ledger Dex, and happy trading.